Good afternoon, and thanks very much for giving me the chance to talk to you today about the investment team at Fidelity, and specifically about the Special Situations Fund that I run at Fidelity. The title of the presentation is Opportunity in Uncertainty, and clearly there is an awful lot of uncertainty in the world today, as there has been for many years. But at Fidelity, I think this process really has the ability to benefit from that opportunity that we see in uncertainty. And I'm going to talk through how we do that and how the returns have turned out from this strategy over almost a 40-year period that the fund Special Situations has been going for. So the first bit is just going to talk a bit about sort of why Fidelity, why this process works. And then I'm going to go on to talk about sort of some of the stock ideas and positions in the fund today. So we've got a very big team at Fidelity, and many of the slides will talk about why this is a real benefit to this type of fund and this type of investment in particular. So while I've been at Fidelity for 16 years and have wide market experience, it's really those 40 people in London covering European stocks that are a key driver of the returns in the process. So the fund itself, hopefully most of you will be aware of it. It's one of the longest running unit trusts in the UK from 1979. There's only been 3 managers of the fund over that almost 40-year period. Obviously most famously started by Anthony Bolton. Sanjeev Shah took over after him, and I've been on the fund just over 3 years now, carrying on the same value contrarian heritage of the fund that's been so successful over that time period. So this next section is where we get a question, and so hopefully you've all got your apps today that can answer this. So basically, if you had invested in this fund right back in 1979, and you'd put £1,000 in, what would have the return be? So there you've got the 4 options here: 30,000, 58,000, 302,000, or 589,000 are your 4 options. Okay, so we're going through how many of the answers are here. So obviously the top 2 seem to be the most popular in the audience. So let's see if we can actually get the final tally. Okay, so indeed, only just in the room, 58% for number 3. Oh, going down a bit. 302,000. And £420. I'll give it a minute while we get the final total. There we go. So the answer was, as the next slide shows, number 3. So most of you got it correctly, although only just the majority in the room. So hopefully that demonstrates that this process over the very long term has delivered a phenomenal return for investors. So £1,000 turned into over £300,000 in that near 40-year period. Hopefully, we're also going to demonstrate that this process continues to have the ability to add value going forwards. And you can see the shorter-term performance over the last 5 years, including the last 3 where I've been on the fund, with continued substantial outperformance of the market, beating the market in 4 out of 5 of the last 5 years. And indeed, I think this is a process that over the long term can generate very strong returns above the market, although I wouldn't expect this approach, given its contrarian nature, to beat the market every year. And indeed, you did see 2014 being a tougher year for the process, where we slightly underperformed the market. But overall, you can see the compounding effect of those market-beating years, showing that the strong performance over time. So the next section of the presentation goes on to talk about sort of what do we do, how do we invest, and how do we generate these returns over time. And this process is very much around looking for companies where there is change happening. So we're not looking for companies that are staying the same. What are we looking for is real change within companies and industries. And the first thing I like to look for is industry change. So here we're showing sort of where there's capital leaving an industry. That's something I particularly like to see. So if companies are cheap, returns are poor, profits are bad, and people don't like an industry, actually at some point, people will start to exit. And that's something I really look for. Particularly, this has happened in the banking sector, which is a sector I really like today. So analysts are looking for things that are happening on an industry basis. The second type of change is where things are changing within the company itself, so the stock investment we want to make. I particularly like to see new management coming into companies. I think that's something that's very positive for enacting change. It's much easier to fix things if you weren't responsible for those problems in the first place, and so we look for that. We're not looking for necessarily the world's best companies, but what we're looking for is companies that are trading below their intrinsic worth, where there can be an improvement. And that's where the Fidelity analyst team really come into their own, doing due diligence around what a potential improvement could be in the companies we look to invest in. So what do we look for in those changes? So first of all, it's important that we like to look for lots of things. So metaphorically, we're looking for lots of shots on goal in an investment case. I think if there's a significant change, that's also beneficial, because again, there can be that much more upside rather than a change at the margin. And what's important is doing these channel checks. So harking back to that analyst team, management teams are clearly going to talk up their prospects when they see investors, talk about what they think they can change. But actually, what's really valuable is when you go away and talk to customers, talk to suppliers, talk to competitors, are those changes actually coming through, and are those changes credible? And that's where we get our real confidence in the investments, and when we get that information, that's where we really build up the big positions in the fund. It's also important to make sure we think that we have an edge on these companies. So if this is a change that everybody expects and does lots of work on, then again, your upside isn't going to be that big. It's looking for the uncovered gems, the stocks which are unpopular today, where we really get the real upside. So talking a bit more, how does the interaction work? So clearly, I'm the fund manager on Special Situations, but it's this team behind me that really helped me out in doing that deep delve analysis work. So I like to see companies myself, so I tend to make 2 to 3 companies a day in our London offices just outside of St. Paul's. That's a really key part of the process, but actually it's not the only part of the process, and really the important part is the 4 or 5 further meetings that we then do with those customers, with the competitors, going away and doing off-site meetings, actually site visits of companies, particularly if their operations are abroad, where we can really get sort of more value-added due diligence. And it's that the analyst team is totally key for, because we've got about 100 investments in Special Situations, so that's an awful lot of companies to see and do the work on. And so this big team is absolutely key for not just sort of doing the due diligence on the ideas, but actually coming up with some of those ideas and sparking those investments in the first place. And so this is very helpful, the fact that we have one of the biggest teams in London available to help me on the fund. So the next part of the presentation talks a bit about how Special Situations is actually invested today, and goes into some of the companies that I actually own and think have significant upside going forward. So the first slide I want to talk about is financials. So I really like the financial sector. It's actually 32% of Special Situations assets today. But actually, that is quite diversified. So banks are quite a high-profile holding, but actually they're only 12% of the fund. And across other financials, there's almost as much of the assets invested in insurance and diversified financials. And I think the reason for financials as a whole is, first of all, it's a complicated area. So these businesses often have complex business models, very difficult to analyze accounts, and certainly in the case of Burford, are more or less the only player in their industry on the quoted markets. And this means a lot of investors shy away from this area, particularly given the experience we've seen with the global financial crisis. People have sort of said, this is too complex, these are potentially dangerous investments, we just won't do the work. And this is where you can really get an edge on some great business models. So if you go on to maybe another area that I really like, and we're going to talk about 2 stocks now. So first of all, Ultra Electronics. So this is a much more stock-specific call, although again, within an industry that I think is recovering. So both changes happening here, both on an industry level and at a company level. So first of all, what's happening in the defense industry? So Ultra Electronics is a defense company, primarily with end markets in the UK and US. So the US defense budget has been falling for a number of years. So from a peak in 2010, when the US was fighting the Iraq and Afghanistan conflicts, down to a trough in 2015. So clearly the whole sector has been under pressure as revenues have been falling. If you look at future requests, though, in terms of fiscal budget projections, you can see in the US under the old administration, there was already an increase in 2016, and then that planned to go out until 2021. And with the new Republican administration, you can see an increase is proposed over that level, quite a substantial increase back to some of the peak levels we saw previously. So while we may not see levels as good as that, I definitely think there's quite a bit of upside to the overall defense sector spend as a whole. It's just a question of how much growth there is. If we then zero in on what's happening at Ultra as a company, it's very much around what has the free cash flow of this company been and what is it likely to be in the future. So you can see back in 2011 a very good level of free cash flow. That then was much weaker over the next 4 years. And there's two specific reasons for that. First of all, obviously the overall negative defense outlook and the reduction in revenues because of that, but also a very large and very problematic contract for them in Oman when they were looking to put in actually on the civil side a lot of information around a new airport that was planned there. That actually was a contract where they're still in dispute and they didn't actually get paid for, so it really affected the free cash flow of the company. And that really put a lot of investors off the stock. It's a traditional very high rating fell down because people saw that very poor free cash flow conversion. But I think clearly once we've done the analysis, had a look at the accounts, met the company, talked to some industry consultants and some competitors, it was very clear that Ultra was still performing very well across the rest of their business, and it was only really this large problematic contract that was hurting the business. Now that contract, the last cost for that went out of the business in 2015, and we've actually already started to see an improvement in the free cash flow of the company. And you can see going forward, what our analysts have modeled in terms of cash flow going forward, a strong increase back towards those levels we saw in 2011. So I think an attractive stock in terms of its ability to generate cash, going back to some of the historic levels when a lot of people were expecting that those levels would never be produced again. So next slide talks about a company that I think most people sort of get wrong in terms of sort of what they think it does and what its drivers for future growth are. So this is a small cap company, one of the many mid and small cap stocks that we have in special situations. You find them worldwide, particularly in Europe, in supermarkets and shopping centers, but this isn't actually a retailer. There's a major opportunity for growth in security, and I think that surprises many people. And there's about a 5% dividend yield and a net cash balance sheet, which are quite unusual in the market today. So this is Photome, which is about a 1.5% position. It's a business that many people presume is ex-growth, with the potential for their market to be electronicized over time, with people submitting photos directly from their smartphones, maybe for passports and driving licenses. Actually, if you take a step back and do the work on what that means, you can see that that is actually not something governments want to do. Despite the fact it would be very low cost, it's very open to fraud. So clearly it's very easy to manipulate a photo electronically and submit it online, whereas actually a photo booth is quite a secure environment. And increasingly these booths are actually connected up to the internet themselves, and you can post your pictures directly to governments from the booth, something which is actually very difficult to fake. And they're already doing that in France, and they have contracts in Ireland and Germany, and are negotiating in the UK. Additionally, this business has the rollout of a laundromat product. Again, you'd think quite a basic product. It's just a couple of laundry machines that sit in car parks, again, primarily in France, but incredibly high returns on capital for that, because again, they already have the maintenance people that go out, empty the money, check that the photo booths in those supermarkets are working, so the incremental cost of this is very low, and therefore you get about a 50% return on capital, or your money back in 2 years, on those laundry machines. So that's a very good growth angle for the business, given their wide footprint already in photo booths, as well as that security angle, which has the potential to yield better returns on the traditional business. So far from a business that's potentially in structural decline, I think quite a growth angle here. And again, it's trying to get these companies where we think we have that differentiated view to the market, where there's very little analysis potentially, especially because it's quite a small cap stock, has quite a maverick CEO that doesn't necessarily sort of interact with the market in the same way as many other companies, and therefore we can get an edge on this stock. So to finish up, I like to use this slide in many of my presentations as a final slide. The reason I like to do that, despite it being obviously quite a busy slide, is that we've talked about some specific examples in special situations of sectors that I like or stocks that I like. But overall, it's a very diversified fund. So the real power of that long-term performance is from a very diversified 100-plus stock portfolio. And you can see some of the big names here. And it's getting an edge on these individual change stories within each company that really gives the outperformance. And so names in stage one, this is where I like to buy the companies, where often there is an issue, there's some controversy, and the stocks are at low valuations. Stage two, this is where the change I'm hoping for starts to come through. Often you'll see companies start to outperform at this point as not only earnings improve, but also the rating that the market applies to those earnings increase. And then stage three, this is where the change I was looking for has come through. Valuations are now in line with peers or history. These are viewed generally as good companies, and indeed there's nothing wrong with these stocks. It's just that the valuation is now up with events. Now I'm looking to sell out of these names to recycle back into more unloved areas in stage one. And that really is sort of what we do in the fund and how we generate the performance. So obviously the normal disclaimer at the end, but thanks very much for listening today, and hopefully you'll all get the chance to visit the Fidelity booth that we've got down at the front of the building, which can obviously give you more information both about this fund and our wide fund range at Fidelity. Thank you.